Uh, so, so welcome to uh, Accounting 605, Accounting for Managers. Well, we finally made it into week two already. It goes by so fast, doesn't it? It really is just cruising on by. So, happy to have all of you with us as we explore this topic. Um, so I'm going to go ahead and start by sharing the PowerPoint presentation, which will be posted along with the recording after today's session. And you could always reach out to me if you have any questions or any type of clarification that you might need or anything like that. So, um, and as always, if you have questions along the way, feel free to unmute your microphone and ask your question, or you can type it into the chat or whatever is most comfortable for you. Okay, so today we're going to be talking about using accounting financial statements for decision making. And we do this in a couple of different ways. And so we're going to talk about all of the different methods that we use. We're also going to talk about revenue recognition, when do companies recognize revenue or sales? And we'll also look at expense recognition, very briefly about the generally accepted accounting principles, what they are, how they're used, that type of thing. And I'll try to make this as streamlined as possible. Um, so yeah, that's what we'll do today. We're going to run through revenue recognition, matching principles, also known as generally accepted accounting principles. I'm going to explain what they are, how they're used, why we use them, that type of stuff. And then we'll also go through the process of understanding how we analyze financial statements and why we do it. So the first thing I want to talk about are generally accepted accounting principles. So generally accepted accounting principles are the way that we govern our financial accounting. And general accepted accounting principles wants information to be relevant and of faithful representation. Relevant information affects decisions of our users. So we make decisions based off of generally accepted accounting principles. It helps to kind of guide our decision-making process. Faithful representation means the information it accurately reflects the business results. So the idea here is that generally accepted accounting principles validates uh, our information. It says that yes, this is true and accurate. This is transparent. We can make decisions based off this information. So that's the whole idea behind generally accepted accounting principles. Helps like really govern financial accounting. In addition to generally accepted accounting principles that we use here in the United States, other countries around the world use other sets of information of governing principles. In the United States, what governs our generally accepted accounting principles is the Financial Accounting Standards Board. In Washington, D.C., there is a group that composes the Financial Accounting Standards Board that sets the standards within generally accepted accounting principles. And all of this authority is provided by the Securities Exchange Commission, or the SEC. And of course, by now you're familiar with what the SEC is and what they do. And the reason why I know that is because that's how you got your information from your publicly traded company, by going to the SEC.gov website. The SEC is a government agency that oversees the proper use of generally accepted accounting principles by companies that sell stock and debt to the public. And it's important to also know that an auditor examines whether the financial statements are prepared according to the generally accepted accounting principles. Here in the United States, it's required that every single publicly traded company is audited by an independent auditing firm. This firm is outside of the company. They come in from the outside and they audit the generally accepted accounting principles used by the company. And through this process, the auditors are validating the information found in the financial statements, the income statement, balance sheet, statement of cash flow, statement of retained earnings. The auditors validate the accuracy of the information that you're reading in those 10K reports. So that's the whole idea behind when you hear a public auditing firm. It's usually one of the big four or big three these days. KPMG, PricewaterhouseCoopers, Grant Thornton, just to name a few. And these firms that they audit publicly traded companies, right? They're validating that it's true and accurate. And all this is based off of what the SEC governs through the Financial Accounting Standards Board and using the generally accepted accounting principles. So that's what the framework is that we use here in the US when it comes to our financial reporting. And within that framework, we have what we call a conceptual framework that helps us in that organization, right? So this is a Financial Accounting Standards Board framework. And in looking at this, we can see the foundation of how we formulate our accounting standards. So the objective here, of course, is to provide information that is useful to our investors, creditors, and other external stakeholders. And of course, you learned about that last week when and I think it was in the it was Unit 1, and I think it was the first part of Unit 1. We talked about the stakeholders, right? So the objective is to provide those individuals with clear, truthful, useful information. We do this through what we call faithful representation, right? We require the information to be relevant and of faithful representation. And ultimately what this is it says, hey, yeah, what you're reading here is true, it's transparent, it's accurate, all those things. And ultimately, this framework helps us to define the items found within the income statement, balance sheet, statement of cash flows, and statement of retained earnings. That's our elements. And within, we look at what we call the recognition and measurement. This is the criterion that we use for the item that the item must meet in order for it to be recognized as an element. And we also look at how that element is measured. And so we'll talk a little bit more about these things. It's just the framework. It helps to kind of set the tone for the things we'll look at. So within our generally accepted accounting principles, we have what we call assumptions and constraints, and of course the principles themselves. The generally accepted accounting principles are the composition of those principles, assumptions, and constraints. So just looking at this nice graphical representation real quickly, we have four principles that we follow in accounting. One is called the measurement principle, or also known as the cost principle. We have the revenue recognition principle that tells us when we recognize revenue when we make our sales to our customers. We have the full disclosure principle. You are like 45. I hope not. I'm sorry, Elvis. Are you good? Okay. Just want to make sure. We have the full disclosure principle that, of course, as the name implies, we're disclosing everything in our financial statements. And we have the expense recognition principle, also known as the matching principle. We'll talk a little bit more about those. We have assumptions that we follow. we have what's called the going concern that tells us about the company's ability to stay in business. We call that the going concern. We have the monetary unit assumption. Is it in US dollars, British pounds, the euro, the peso of various countries, the yen, etc. That's the monetary unit. We have the time period. Is the time period a month, a quarter, semi-annual, or annual? And then we have the business entity assumption. Is it an LLC? Is it a C Corp, an S Corp, sole proprietor, whatever? And so with these principles, assumptions, and the constraint being the cost-benefit constraint, this helps to set the framework for everything we do in accounting. So taking a closer look at those accounting principles, the first one being called the measurement principle or the cost principle. This is based on the actual cost of things. So the actual cost is considered the objective. The idea here is that cost is measured on a cash or equal to cash basis. It means that the cash is given for the service or the goods, and it's measured at the amount that is paid, right? So the cost is whatever the cost of that bill was. The cost is whatever the cost of that invoice was, right? That's our cost principle. We measure it at its cost. So it's not implied value. It's not book value. It's technically book value, but it's not market value or anything like that. We recognize it at its cost. The next principle you should know about is called the revenue recognition principle. The revenue recognition principle has two components to it. The first is that revenue is recognized when the services are performed or the goods have been delivered to the buyer. That's the first part. And the second part must also be true. Revenue is recognized at the amount expected to be received by the customer, and the amount that's received is usually in cash, but it's also common to receive a customer's promise to pay in the future, also known as an account receivable. Okay, so I want to break that down real quickly with you. Let's say you purchase something on Amazon and it hasn't shipped yet. Amazon does not recognize that as being a sale until they've shipped the product to you. So that's why sometimes you'll see you went on Amazon, you made the purchase, but it hasn't hit your bank yet, or it hasn't hit your credit card or your debit card or whatever yet. And you might be wondering, well, why is that? Why didn't it hit yet? It's because of the revenue recognition principle. They cannot recognize it as being a sale until they've sent you the product. Okay. Customers will either pay over the counter cash, or they might pay through what we call a credit sale, also known as an account receivable. That's where the customer pays 30 days later, something like that. So that's the revenue recognition principle. The third principle here is the expense recognition principle. The expense recognition principle, also known as the matching principle, states that the company records our expenses when they're incurred in order to generate the revenue that's been reported. The principles of matching revenue and recognition and the expense associated with it are key to modern day accounting. That's why I call it the matching principle. I'm matching the expense when it actually happened and as it's related to making the sale. So an example of that would be, we'll say the rent expense. We record the rent expense during the month that the rent actually occurred, and it matches the sales that we made for that month. You see? So that's an example of the expense recognition principle. And the last accounting principle I want to talk about, at least for today, is the full disclosure principle. This states that a company reports the details that would impact users' decisions. Most of the details are reported in the footnotes to the financial statements. You'll see that that full disclosure principle, uh, you've probably read through your 10K report, right? Your SEC 10K, and you'll see that there's notes to the financial statements. Within those notes, they're disclosing information about what's being reported. Now, throughout last week, a couple of you had asked me the question, hey, Dr. B, I noticed that my company doesn't have investments, we'll say, right? It probably does. It's just not listed out as clearly as it probably could be on your balance sheet. And so that's when you want to go to the notes to the balance sheet, and you'll notice, hey, right, here are the investments, and they're categorized as cash and cash equivalents on the balance sheet. And so it's important for us to recognize that the cash equivalents, part of cash and cash equivalents, are typically where companies will have their investments. And those investments are short-term investments or current investments, right? So that's where that distinction comes into play. That's why it's really important for you to look through those notes to the financial statements. In looking at our accounting assumptions, we have the going concern, which is a company's ability to stay in business and continue to operate. The monetary unit assumption, is it recorded in US dollars or British pounds or the euro or the yen or the peso, whatever, right? And then we have the time period assumption. Did it happen in a month, a quarter, a semi-annual, or a year? And then we have the business entity assumption. Is it a sole proprietor? Is it an LLC? Is it a C corporation, an S corporation, etc.? So those are all the assumptions that tie back to our accounting principles. It's also important for you to know if the company is recording their transactions through the accrual-based accounting system or the cash-based accounting system. And for reporting purposes, through the Internal Revenue Service and through the SEC, generally accepted accounting principles requires us to use accrual-based accounting. But some of you might own a small business and you might do it through the cash-based system, which is fine. But when it comes to reporting, you have to make sure that we do it in accrual-based accounting. So just to quickly explain the difference between the two. With accrual-based accounting, we record the revenue from our which is our sales, when the service or product has been delivered to the customer, and we record our expenses when they actually happened or when they were incurred. This matches our revenue and our expenses. That's what the accrual-based accounting system is. On the cash-based accounting system, this is when we record our sales or revenue when cash is received from our customer. And we record our expenses when cash is paid for our expenses. It's a very simple system. A lot of small businesses use the cash-based system because it's easy, right? But as I had mentioned before, if the company is publicly traded, or if the company's reporting to the Internal Revenue Service, they need to be able to do it in the accrual-based accounting system. So, and I'll also say the biggest difference between the two is that the accrual-based system is going to be more accurate. It's going to show the actual business's performance as it occurs throughout time. Whereas the cash-based system is going to be relatively different. Now, I'll show you what those differences look like here in a second. I'd mentioned the accounting period or the time constraint, right? Time constraint, again, could be a month, a quarter, semi-annual, or annual. That is how companies report their financials. So, for example, here in Maryland, for my company, for my consulting business that I have, I pay my taxes quarterly for my business. And a lot of small businesses do it that way. We pay our taxes on a quarterly basis. So we follow the quarterly system. But in my QuickBooks, or my accounting software, I track my expenses and revenue monthly, and it helps me to be able to figure out how much I need to pay in taxes. Right. So that's why it is super important to understand the accounting period. This is the time period assumption. This is especially important when it comes to recognizing revenue. We rely on two principles in this process. We rely on the revenue recognition principle and the expense recognition principle, which is also known as matching. The revenue recognition principle requires that the revenue be recorded when the goods or services are provided to the customer and at the amount expected to be received from the customer. The major goal here is to ensure that our revenue is recognized or reported during the accounting time period in which the goods or services were provided to the customer. So here I have an example. So a software company sells a 1-year license to use the software, and they offer ongoing support for that software. Should they recognize the revenue all at once or over time? And the answer here is it depends, right? So I'm going to recognize the sale or the revenue when I've provided the software to the customer. Okay, that's the sale of the license. However, I'm also going to recognize the revenue as I'm offering support. You see, so there's really two components here in the revenue recognition for this example. So just something to think about. On the expense side, the expense recognition or the matching principle aims to record expenses in the same accounting period in which the revenues were recognized as a result of those expenses. Right? So I earn the revenue by delivering the product or the service to my customer. I also have expenses that were incurred as a result of that sale. And so I need to record those expenses during that same month or during the same accounting period. That's what that tells us. Here's one of my favorite examples: prepaid insurance. Oftentimes in business and in personal life, think about like your auto insurance or your home owner's insurance or renter's insurance. Oftentimes we pay for an entire 12 months in advance, right? And the reason why we do that is a couple reasons. One, it's easier. Number two, I might get a discount if I do it that way. That, or maybe the landlord requires it that way, or whatever, right? But so I like to use the example of prepaid insurance. And now this is using the accrual-based system. Now remember, the accrual-based system tells us that we need to recognize our expenses when they were actually incurred. So take a look at this example. Here I have 2 years of insurance that I'm paying up front. So on December 1, 2021, we paid $2,400 for 2 years of insurance beginning December 1. And so we made the $2,400 payment, but that's not how I'm going to record my expense. I recognize the expense when it was incurred or when it was used, right? So what I'm going to do here is I'm going to take the $2,400 and divide that by the 24 months, which ends up being $100 a month. I'm going to spread that across the 24 periods. And so here we have the example of the accrual-based accounting system. I'm matching the expense based off the benefit in which it was incurred. That's accrual. On the cash-based accounting system, we recognize the expense when we pay the cash. So as you can see, December 1, 2021, it's going to show my expense for insurance being really high, 2,400 bucks. And then it's going to be zero for the next 2 years. So you can see the difference, right? It does show a difference when it comes to the overall, I would say, accuracy of the company. So that's why it's always best to follow the accrual-based system. Now, as we recognize revenue, we follow this five-step model. And this is based off of ASC 606. And what it tells us, which is, an accounting standard, and it tells us uh, the process. So the first thing we do is we identify any contracts that we have with the customer. The second thing we do is we identify the performance obligations in that contract. The third thing we do is we determine the transaction price. The fourth thing we do is allocate the price to the performance obligation. And the fifth thing we do is recognize the revenue when each performance obligation is satisfied. So as the products are being or goods are being delivered to the customer. So this is the reason why some of you may have noticed on your 10K report under liabilities you may have seen something that said deferred revenue. Deferred revenue is what that means is that the company had received payment before the good or the service has been provided. And so that's why we list it as a liability, because ultimately it belongs to the customer until the company provides the good or the service. A couple of things happen when we violate the generally accepted accounting principles or the revenue recognition process. It results to what we call misstated financials. We might overstate or understate the earnings, and this could lead to potential misrepresentation of the company's performance. It also leads to investor mistrust. When there's issues in the financial statements, they don't really reflect the reality, and therefore the confidence, they may not be, and it also damages the brand of the company, et cetera. It could lead to a lot of problems. That could also lead to violations and sanctions by the SEC. So, when I think about that, it brings up a case that happened long ago in the very early 2000s, about 2001 is when this case came to light in the public. It was Enron. Enron was an energy company based out of Texas. They fraudulently created a lot of sales. They voided those sales out, and the reason why they did that is because they created a bunch of fake invoices. Why they did that? It was to attract new investors. It made the company look like they're real profitable, and obviously that's fraud. Well, that's fraud. Okay, so don't do that. But that's what Enron did, right? And so it led to a lot of problems. Ultimately it damaged the company to the point where they went out of business. But then it also led to even worse situations. A couple of people went to prison, and it just wasn't good for the investors because the investors lost a lot of money. So it's important that we avoid things like that and protect the brand at all costs. So yeah, there's real world impacts to all this stuff. So revenue recognition, we recognize revenue when it's earned. That means we deliver the good or the service. Matching principle, we match our expenses related to the revenue during the same accounting period. And the impact is that it could negatively impact the company's reputation, regulatory compliance, etc. So just things to be aware of when it comes to how we recognize revenue. Okay, so I'm just going to breeze on through this one. Now, a couple of things before we jump into financial statement analysis. First is that I'm reminding you of what we talked about last week. And the reason for this is because it's important to understand why we perform financial statement analysis. It applies to what we do is we take analytical tools to the financial statements to identify related data for making decisions. And so we have internal users and external users of information that you're aware of. We talked about this last week. Internal users, those are the people that are internal to the company, managers, officers, internal auditors, people that work for the company. Then we have external users. These are shareholders, the government, lenders, suppliers, etc., people outside the company. And the purpose of why we do financial statement analysis is we need to understand the overall company's performance and their financial condition. And we look at this, their performance and condition in three different ways. We look at past performance and current performance. We also look at their current financial position. Do they have enough to be able to pay bills, etc.? And then we also look at future performance and risk. Do they have the ability to continue to operate? So, Justin, great question. Justin's question in the chat is, you recognize revenue over multiple periods and expenses over multiple periods without receiving the revenue, or is it just recorded as expenses, or is it revenue too? Great question. Okay, so the way it works, Justin, is that we recognize revenue or sales as they happen. So in most cases, and for most businesses, that's pretty much every single month of the year, hopefully. They're recognizing some type of revenue. They're also recognizing expenses every single month, and they match when we receive the revenue. So every single month, we create an income statement, and that income statement is based off of our sales, our revenue, and all of our expenses. And so we do that every single month. And then at the end of every single month, we go through what we call a closing process, and we close those out to our balance sheets, to our equity accounts. And then we go through that same process every single month. We recognize both revenue and expenses as they happen, or as they're incurred. Yeah. Great question. But yeah, we do that for multiple periods or multiple months. Okay. What else can I tell you? Yep. So let's take a look at a couple of different ways that we analyze those financial statements. Absolutely, my pleasure. We look at liquidity, efficiency, solvency, profitability, and market prospects. And we do this in a couple of different ways. Um, and the first thing we do is we look at the company's income statement, balance sheet, statement of uh, owner's equity or stockholders' equity, statement of cash flows. And then we also look at the notes to the financial statements. This is the stuff that you looked at in your SEC 10K reports. You'll also be able to see a lot of this stuff on the company's shareholder website, where you'll be able to find things like shareholder meeting minutes, forecasts, management letters, auditors' reports, webcasts, audio files, etc. All these are found on the investor relations page to your company's website. And oftentimes we supplement that type of stuff with our notes. So we look at all that data and then we start to go through the process of making comparisons. To understand what our standards are, it's important in business to know where your standards are, or your benchmarks. And we do that for comparison reasons. We want to compare our company to other aspects of our company, also known as intra-company. This is a company's current performance compared to prior years in relation to in between financial items. We look at the data for competitor reasons. For example, we want to understand the comparison between Coca-Cola and Pepsi in order to be able to make a competitor comparison. How do the competitors compare to each other? That helps us to benchmark. Um, let's see. The industry, we look at industry statistics to set standards, and we also look at other guidelines or rules of thumb, such as current ratio, asset test ratio, results, that type of stuff, which some of you did identify in your I'm sorry, executive summaries. So these are the types of things we do in order to set the standards and comparisons for our company. We use analytical tools like the horizontal analysis, vertical analysis, and ratio analysis. Horizontal analysis, we look at the financial condition and performance of a company across time. As we're comparing 2024's results to 2023's results to 2022's results. That's what we call horizontal analysis. We look at each line item on our income statement and balance sheet, and we compare that from year to year. That is what we call a horizontal analysis. It's on the horizon line. We also do what we call a vertical analysis. This is where we compare the financial condition based on a base amount. So, for example, I'll look at the balance sheet and I'm going to identify each line item on our balance sheet as a percentage of total assets. In other words, what percentage of cash was derived out of my total assets? What percentage of current liabilities was derived out of my total assets? What percentage of total equity was derived out of my total assets? That's what we call a vertical analysis. We base on everything as a percentage of a base. For the balance sheet, it's always going to be based on total assets. On the income statement, it's always based on total revenue. And the other thing we do is we do what's called a ratio analysis. We calculate so many different ratios to get a quick idea of the financial condition of the company. And I'm going to show you what all those look like. So first, let's take a look at our horizontal analysis. This is where we look at data across time. So from year to year, I compare 2024 results to 2023 and to 2022. The way that I do that is through a formula. And I do it either expressed as a change in dollars or a change in percentage. When I express it in a change of dollars, I take the analysis period amount, so 2024's amount, minus the base period amount, 2023 or 2022. When measuring the amount of the change in dollars, we compare the analysis to the base period. So what's the difference between 2024's dollar amount to 2023? That's really it. It's very, very straightforward. We can also express this as a percentage. And when we express it as a percentage, we take the analysis period amount, so 2024's amount minus 2023's amount, and then we divide that by 2023's amount, or the base period amount. And then we multiply it by 100. And what it does is it gives me the horizontal analysis expressed as a percentage. So here's what it looks like on the balance sheet. So the current year compared to the prior year. So 2024 minus 2023 gets me to the dollar change. 2024 minus 2023 divided by 2023 times 100 gets me the percent change. And then you can see that I do that for every single item on my balance sheet and my income statement. And I can do this real simply in Excel. It'll take me a few seconds to do in Excel, and it's just a matter of plugging in that formula. Yep. You select equals, select the cell, minus select the cell, close parenthesis, divided by select the cell, and that gets me percent change. Yep. It's very, very simple to do. This is what it looks like on the income statement year to year. So 20 current year minus prior year gets me dollar change. Current year minus prior year divided by prior year gets me percent change. And that is how we perform a horizontal analysis. Now that's from year to year, right? I can look at it also for longer periods of time. I could look at it for 3 years or 4 years or 5 years. And when I do it that long, really what I'm looking for are trends. And in order to do that, we use what we call the trend analysis equation. And the trend analysis, as the name implies, helps us to identify patterns or trends. And we express that as a percentage. So here we take the analysis period amount divided by the base year times 100. So looking at this example, I can do it for several years. So here I have 5 years of data. My base amount is going to be year 4 or year 5. And I take the analysis year divided by the base year times 100. And so what that does is it helps me to identify the trend across time. We can also graphic it out. This is great thing to show for people who don't understand finance or accounting is to show them graphically. I used to do this a lot in my consulting business. I still do to small business owners who don't really understand their operation from an accounting or finance perspective. So showing them graphically, it's awesome because it really helps them to get a really good understanding of what their company's performance looks like. You'd be surprised. A lot of people don't know how to read an income statement, balance sheet, statement of cash flows, whatever. They don't know how to read them, which is fine. But when you don't know how to read it, you really don't understand what's going on. So in order for us to be able to teach other people, we show them graphically, right? It just makes it easier for them to understand the trends. So that's horizontal analysis. And now let's take a look at vertical analysis. For vertical analysis, I'm looking up and down the financial statement. I express everything as a percent of the base amount. We oftentimes call this common-sized financial statements. The idea here is that I'm making everything a common size. I'm expressing it as a percentage of a base. And the way I do that is I take the analysis amount divided by the base amount times 100. The base amount on the balance sheet is going to be total assets, and the base amount on your income statement is going to be revenue. So I take whatever it is on my balance sheet divided by total assets, whatever it is on my income statement divided by total revenue. And that expresses everything as a percentage. And so what does that look like on the balance sheet? I express everything as a percentage of total assets. So for example, in the current year, my cash and cash equivalents was 48,844. My total assets was 338,516. So if I take the 48,844 divided by the 38,516, I get 0.144 times 100 is 14.4%. And so I use that same concept, that same formula. I apply it to every single line item on my balance sheet to express everything as a percentage of our base. Now, the reason why we do that is we want to be able to compare the percent change over time. Yeah, Justin, no problem. Was it this one? The formula that you wanted to see? Great, awesome. Yeah, so in looking at this, again, I express my analysis amount divided by my base amount and times 100, and that'll give me my percentage. We express everything as a percentage of my total base amount. It helps us to put it into respect of percentages. So in other words, I'm comparing myself to prior years and as a change in percentage. right? That's a way to think about it. Yeah, my pleasure. And so that's what we do with the balance sheet. We express everything as a percentage of total assets. So current year, this is the analysis amount divided by the base, and comes to 14.4% in this example. And I do that with every single line item. And you'll know you've done it correctly when your total assets is 100% and your total liabilities plus equity is 100%. And that's because the accounting equation is assets equals liabilities plus equity. So it just kind of helps to validate things. On our income statement, we express everything as a percentage of total revenue, total sales. And so here we can see everything expressed out. This is great for business because it shows us what our percentage of total costs of goods sold are, what our gross margins look like, how much they've changed over time, that type of stuff. So it's really, really good information. Yeah, that's why I like it. And it's quick, it's easy.
Those are a quick clarification
Yep.
regarding I had a similar question to Justin about the common size percentage. Um,
Mhm.
because the equation is the same for the trend analysis, is it just that the difference is the trend analysis is the horizontal and the common size is vertical?
Oh, you're almost there. So the trend analysis is horizontal, and we look at it for multiple years. So for the trend analysis, our base amount is actually going to be the oldest time period amount. So if I'm looking at a data set and I got 5 years of data, the oldest year is going to be my base year. And my analysis amount is going to be the years that follow, if that makes sense.
Yes,
So,
thank you.
yep, awesome, very good, great question. But yeah, vertical analysis very good tool to use. It's also great to be able to express everything through graphs and charts. Because once again, oftentimes you'll be working with an executive that might be like a scientist or whatever. They don't understand a lot of these numbers, right? So oftentimes we have to explain to them what it is that they're looking at. We do that through graphs and charts. It just really helps people to really understand it from a visual perspective. So the way I think about it is, if I don't know if this ever happened to any of you, but I've gone in front of boardrooms and given presentations on income statements and balance sheets and whatever, and I put everyone to sleep, because it's so boring. They're like, "Oh man, Dr. B, here he is again, talking about his data." It's like, okay, but if I show them this, it's a little bit more meaningful because it just kind of keeps the brain a little bit more focused and like, oh wow, I never looked at it that way. So it just kind of shows them a nice graphical representation. That's why I love these charts and graphs to be able to show people really what's happening with their company. They get a better appreciation for it. Now, the last thing we'll talk about today, and I'm going to breeze through a lot of these because I'm going to be providing you, of course, with this presentation. But we look at a lot of our financials by doing very quick ratios. And these ratios, they help us to understand the overall financial health of the company in a really fast and easy and meaningful way. And so we'll look at several different ones, but I'm going to touch on probably the most important ones that I want you to know, because ultimately they're all important for their own reasons, but it's a great way for us to get a kind of like quick understanding of the overall financial condition of the company. So we look at liquidity ratios and efficiency ratios. Liquidity is the company's availability of resources to pay their short-term cash for the short-term cash requirements. So in order for the company to pay its short-term liabilities, they need to have enough liquid assets to get to be able to do that, right? Um, this is affected by the time that cash comes into the business and cash going out of the business with respect to future performance. That's what liquidity shows us. And efficiency is how productive the company is at using their assets to generate sales. So that's and these are the types of ratios that we very commonly compute in order to determine the company's liquidity and efficiency. The first one, this is the most common one, is called the working capital ratio. Shows amount of the current assets minus the current liabilities. We call it the working capital, right? The working capital is the company's ability to repay debts and continue operating, right? So I might compute a quick working capital to understand the company's ability to repay some debt and to continue operating in the future. I, this one's my favorite one, just personally, me speaking, favorite one. The current ratio, this is current assets divided by current liabilities, shows us the company's ability to repay their current debt. Yep. Um, Anything above one is great because it shows that they have the ability to repay their debt. Uh, 1.5 is awesome. Anything above 1.5 is really good. If it's below one, the company might be in trouble. It shows signs of weakness in the company. Acid test ratio. Uh, this one's okay. We take cash plus short-term investments plus accounts receivable divided by current liabilities. Um, this one's good. It reflects the company's short-term liquidity. Yeah. Um, it's good. It's a good one. Not my favorite. Accounts receivable turnover. Uh, we take total sales divided by average accounts receivable. In business, when you or in accounting, when you see the word average, we want to take the beginning balance plus the ending balance divided by 2. In accounting, when you see the word average, we take the beginning balance plus the ending balance divided by 2. I had a student ask me recently in this class, Dr. B, the beginning balance isn't a thing on my we'll say balance sheet. How do I find it? The beginning balance should also be the ending balance from the prior year. Okay, so December 31, my ending balance, December 31, should be my beginning balance for January 1. See how that works? So just something to think, because if you don't see it in your financial statements, don't worry. You can compute it by knowing what the ending balance was from the prior year. Ben, if it's below one, the company invests heavily. Is that also negative? Oh, great question. It depends, right? I so I'm going to give you the example of Sears. Yeah, for the current ratio, exactly. Uh, so I'll give you the example of Sears. When did I notice that Sears was in trouble? Their current ratio dipped below one. And now the reason why this happens, as you mentioned, could be for a couple different reasons. One is that they could be taking too much of their current assets and reinvesting it into the business to grow the business. Oftentimes that results in what we call hyper growth or too fast of a growth. That could be good, but it could also be really bad because what's happening here is that they're putting too much of a strain on their short-term liquidity. And when there's too much of a strain on short-term liquidity, it oftentimes results in negative action. So in the case of Sears, for example, when their current ratio fell below one, I knew the company was going to be in trouble because it shows that they didn't have the ability to continue to repay their current liabilities in the short run. So it depends really. Um, it depends on the type of business that they're in. If the company has a current ratio that's less than one, it could mean that they have a lot of capital intensive projects that they're putting forward, which is but the negative side of that is it puts a strain on their ability to meet their current obligations. So great question. Overall, it depends. But if it falls below one, it's a sign of serious risk. Serious risk. That's the best way I could put it. Great question. Uh, yeah, accounts receivable turnover, when you see the word average, beginning balance plus ending balance divided by two. Inventory turnover, how effective the company is at selling through its inventory, or how long it takes for them to sell through their inventory. Costs of goods sold divided by average inventory, beginning balance plus ending balance divided by two. Days sales uncollected, how long it takes for them to receive payment from their customers that pay on accounts receivable. Accounts receivable divided by sales times 365. Days sales and inventory, how long it's sitting on our shelf. Ending inventory divided by cost of goods sold times 365. Yeah, my pleasure. Total asset turnover, total sales divided by average total assets. Beginning balance total assets plus ending balance total assets divided by two. Then we have solvency ratios. This tells us about the company's ability to maintain its current liquidity status. Also tells me about the company's ability to be solvent. Solvency is the ability to pay all of its current and long-term obligations. The debt ratio and equity ratio, very, very common ratios to compute. These are also computed on you when you go to take out a loan from the bank for, like, let's say, a car or a house. Debt ratio shows total liabilities as a percent of total assets, and the equity ratio shows us the total equity as a percentage of total assets. It's always going to be 100 when they're combined. This is also good to understand what the company's debt structure looks like. Then we have the debt to equity ratio, total liabilities divided by total equity, shows us what proportion of the company's assets is being contributed by loans. Right? Larger debt to equity implies less opportunity to expand using debt financing. Times interest earned shows us the company's ability to repay interest expense. Income before interest expense and income taxes divided by interest expense. Profitability. These ones are important, especially for Unit 2. Gross margin ratio. This is a great one because we need to know how much potential profit margin stems from each dollar of sales. So we take total sales minus cost of good divided by total sales. That gives me my gross margin ratio. Profit margin, also extremely important. Company's ability to generate profit from each sales dollar. Take total net income divided by total sales. Super, super important for that one. Every company needs to have a good margin. Good margin. I like anything over 20% in my mind is good. Return on total assets, how effective the company is utilizing its assets to generate profit. We take net income divided by average total assets, beginning balance total assets plus ending balance total assets divided by two. Return on equity, the company's ability to earn income for its stockholders. Net income divided by average total equity. That's a good one too. And then we have a couple market ratios. This tells us a little bit about the company's stock price, that type of stuff. Market price earnings for common share divided by earnings per share is the price to earnings ratio. Tells us about future growth in the share price. And then we have dividend yield. We take annual cash dividends per share divided by market price per share. This gives us an idea of the company's ability to pay a dividend in the future. These two slides right here, these are really great summary slides. Of course, this whole presentation will be made available to you, but I always like having everything together in a nice orderly fashion. So that brings us to the end of today's presentation. I want to very quickly just show you what is it we're working with for this week. So under content, we're in Unit 2. Of course, you have the learning resources here in addition to today's presentation. There's a discussion board for you to complete, as there is in every week. So your original post will be due Friday night, with two responses to your classmates by Tuesday night. Um, there is a nice test your knowledge, and then we have the assignment. So when you go into the assignment, you're going to have a, sorry, I'm trying to open up the right one. What you're going to go into here, assignment directions, just like before, you'll open up the Excel template. It'll look like this. Well, the one I provided you looks like this. This is a little bit more straightforward than the other one. So you'll use your 10K report. You'll pump in the dates of the balance sheet and the income statement, and then you're gonna find things like your total assets, liabilities, equity for your balance sheet, and then for your uh, income statement, you're gonna find your total revenue, total expenses, and net income. You'll plug those numbers in over these brackets. And then you're going to do similar with your statement of cash flows, date of the cash flow statement, the cash from operating activities. It's called net cash flow from operating activities, net cash flow from investing activities, net cash flow from financing activities, and the net change in cash. All of that will be identified on your statement of cash flows. And then you're going to compute a bunch of ratios. You got the gross profit margin ratio, net profit margin ratio, return on assets, return on equity, current ratio, quick ratio, cash ratio. And then we had got debt to equity ratio and the times interest earned ratio. And it should just be a matter of, equals this divided by that times 100, that type of stuff. And that'll help you with Unit 2 on the Excel side, and then you'll create an executive summary. Of course, this example is not complete, but you'll explain the ratios. We want you to develop a sense of the ability to analyze, right? Demonstrate the analysis in your executive summary. But those are your action items for this week. Are there any comments, questions, or concerns that I can help to address at this time? We're good. Okay, awesome. Well, thank you all so much for your time today. I really do appreciate it. And again, if you ever need anything, just reach out to me. I'm happy to help you. You can email me, you can message me through the classroom, all that fun stuff. I'm always around to be able to answer your questions. So thank you all again. Appreciate all of you. Have a great rest of your day, evening, morning, night, wherever you might be. And if you need anything, just feel free to reach out. I'm here for you. Thank you so much. Take care. Bye bye.